Imagine a company sitting on $189 billion in cash. A company that has made its shareholders some of the wealthiest people on the planet. A company run by one of the greatest investors in human history. Now imagine that company has never paid a single dividend in over 50 years. Most investors would call that crazy. Shareholders want income, right? They want their cut. So why does Warren Buffett, a man obsessed with value, refuse to hand that money back? Here's the twist: it's not stubbornness. It's strategy. And once you understand it, you'll never look at dividends the same way again. Stay with me, because by the end of this video, you'll understand a financial philosophy so powerful, it turned a failing textile company into a $900 billion empire. Before we get into Berkshire's genius, let's get on the same page. A dividend is when a company takes a portion of its profits and distributes them directly to shareholders, usually as cash. You own 100 shares, the company pays $2 per share, you get $200. Simple. Most blue-chip companies do this. Coca-Cola does it. Johnson & Johnson does it. Apple does it. It's seen as a sign of financial health. Hey, we're profitable enough to share the wealth. So here's the question everyone asks: Berkshire Hathaway is insanely profitable. Why doesn't it pay dividends? In fact, Buffett himself addressed this at a shareholder meeting. He acknowledged that Berkshire has paid exactly one dividend in its history, a whopping 10 cents per share back in 1967. And he joked that he must have been in the bathroom when that decision was made. So what's going on? Is Buffett greedy? Is he hoarding cash? Or is there something deeper at play? Here's the heart of it: Warren Buffett believes he can do more with your dollar than you can. Now, before you call that arrogant, hear him out. Because the numbers back it up. The entire logic behind not paying dividends comes down to one word: compounding. If Berkshire earns $10 billion in profit and pays it out as dividends, that money goes into your bank account. Maybe you reinvest it, maybe you spend it, maybe it just sits there. The compounding chain is broken. But if Berkshire keeps that $10 billion and reinvests it into businesses, acquisitions, or stock positions with a 20% plus return on capital, that $10 billion becomes $12 billion, then $14.4 billion, then $17.2 billion. Year after year, without interruption. This is what Buffett calls the retained earnings model. Every dollar kept inside Berkshire is a dollar that can be deployed at a high rate of return, compounding silently and powerfully for decades. Think about this: $1,000 invested in Berkshire Hathaway in 1965 is worth over $35 million today. The S&P 500 over the same period? About $300,000. That's not a small difference. That's a different universe. And a huge part of that difference is precisely because Buffett never interrupted the compounding machine by paying dividends. Here's something most people don't think about: dividends are tax inefficient. When you receive a dividend, you owe taxes on it. Even if it's a qualified dividend, taxed at a lower rate, it's still taxable income in the year you receive it. You don't get to choose when to recognize that income. The company decides, and the IRS takes its cut. But here's what Berkshire's model allows: you control when you realize gains. If Berkshire's stock appreciates and you never sell, you never pay taxes on that appreciation. You only pay when you decide to sell, which might be decades from now, or never if you're passing it to heirs. In many jurisdictions, your heirs receive a stepped-up cost basis, meaning the unrealized gains could be wiped out entirely at death. Buffett has written about this explicitly. He calls the retained earnings model a form of forced savings, but supercharged, because those savings are being deployed by one of the best capital allocators in history, and you're not paying taxes on them annually. A dividend of $1 might actually be worth 76 cents to you after taxes. But a $1 reinvested by Berkshire at a 20% return rate? That's worth far more to you over a 10-year horizon. This is not accounting tricks. This is just math. Now let's talk about what Berkshire actually does with all that retained cash, because this is where it gets really interesting. Berkshire Hathaway is essentially a holding company, but not a passive one. It's a constantly humming engine of capital allocation. When Berkshire keeps your earnings instead of paying them out, Buffett and Charlie Munger, and now Greg Abel, are deciding where to deploy that capital for maximum return. Over the decades, that's meant buying Geico outright and turning it into an insurance titan, acquiring Burlington Northern Santa Fe, the largest railroad in North America, purchasing stakes in Coca-Cola, American Express, Bank of America, Apple, deploying tens of billions during crises, like 2008 and 2020, when assets were cheap and others were panicking. This is the key insight. Most shareholders, if given a dividend, would not deploy that capital as effectively as Buffett does. The average retail investor might spend it, or put it in a savings account, or chase the latest hot stock. Buffett, on the other hand, sits on cash patiently, sometimes for years, and then strikes with surgical precision when the opportunity is right. So when you ask, why doesn't Berkshire pay dividends? A better question is, would you rather have $10 now, or let Warren Buffett turn it into $100 over the next decade? For most long-term investors, the answer is obvious. Now, to be fair, Berkshire doesn't just hoard money forever. There is a mechanism for returning value to shareholders, and it's arguably smarter than dividends, share buybacks. In recent years, Berkshire has been aggressively repurchasing its own stock. In 2020, 2021, and 2022, it bought back tens of billions of dollars of its own shares. When Buffett believes Berkshire stock is trading below its intrinsic value, he buys back shares, which reduces the total share count and increases each remaining shareholder's ownership percentage. Think of it this way: if you own 1% of a pie, and the company buys back slices, you now own 1.1% of the same pie. Your ownership grew without you doing anything. And unlike a dividend, you don't pay taxes unless you sell. Buybacks are discretionary. Dividends create expectations. Cut a dividend and the stock often craters because investors panic. Buybacks allow Berkshire to return value when it makes sense, not on a fixed schedule. It's flexibility built into the capital return model. And that flexibility is worth an enormous amount. So what does all of this mean for you as an investor? Here's the takeaway. Don't automatically chase dividend-paying stocks. Dividends feel good, cash in your account is psychologically satisfying. But the question to always ask is, what's the opportunity cost? If a company pays you a dividend because it can't find better uses for its capital, that might actually be a red flag, not a reward. It might mean the business has limited growth opportunities. On the other hand, if a company retains earnings and has a proven track record of reinvesting them at high rates of return, like Berkshire does, then holding on to those earnings creates far more long-term wealth. The genius of Berkshire's no-dividend policy isn't that dividends are bad. It's that for this specific company, with this specific management team, the math is overwhelmingly in favor of keeping the money working inside the machine. Buffett has said it simply. We will only retain earnings when we believe we can create more than $1 of value for every $1 retained. The day that's no longer true, he'll pay dividends. And honestly, that day probably never comes. Warren Buffett built the greatest wealth compounding machine in the history of capitalism, not by being flashy, not by chasing trends, and not by paying out dividends to look generous. He built it by trusting the math, trusting time, and trusting compounding to do what it does best when you don't interrupt it. So the next time someone says, Berkshire should just pay a dividend, you'll know better. If you found this valuable, smash that like button and subscribe. We break down investing concepts like this every week. Drop a comment below. Do you prefer dividend stocks or growth stocks? Let me know. See you in the next one.